Hey everybody, this is David Skarica. So we're going to look at the market today, and we're going to look at maybe the potential of the market kind of topping out here. I'm going to show you some indications that it could be. We're kind of seeing a similar pattern to what we saw in 2021, early 2022, and about this time last year as well. So I'm going to show you this, right now, and like I am kind of hedged now. I've gotten three bear ETFs I've gotten into. That I'm, going to get into. So we're going to go look at um, the, the S&P here. This is the intermediate term kind of chart, as you can see. So what I kind of want to look at here in the S&P is this price action here and this price and action here. This is again really similar to 2020, late 2024, early 2025 this year, late 2025, early 2026. Notice this topping formation. The market kind of churns, goes slightly higher to a new high, and now is starting to roll over. And I think if we break the 6,800 or so on the S&P, which we're basically one day away from doing, then we can go back to these lows here in the fall, and then and you can see when you break those kind of lows, like when this broke here, this 5,800 last year, boom. Now I'm not saying we're going to fall off a cliff. There was definitely significant reasons for that to happen last year. The main reason being the kind of uh the tantrum that's been going on that went on in the markets at that point, right? So that's kind of the thing to look at here. So and if we let's go back a little further, and then I'm going to show you Bitcoin too. I've talked about this in the past, but what I want to show you is again, if we go to 2021, you can see this here, similar kind of pattern in the fourth quarter, kind of churning a slightly high. Then boom, when you broke those lows, there was a rally back, but that was basically it. And the S&P fell pretty hard from 4,800 to about 3,500. That's 1,300 points. That's about 26, 27 percent from intraday top to intraday bottom. And if we go look at the Nasdaq, which I'm going to show you something interesting in a second, the Nasdaq 100, you can see it fell even harder. It fell from nearly 400 on the QQQs to 250. So that's 150 points, or about 37, 38%. Because the Nasdaq is higher beta. So what I find interesting right now, we'll get into Bitcoin in a second, but if we look at the megs, which are the Magnificent Sevens, you can see this is kind of breaking down here. This is breaking down. You can see the 62 here. And I own an ETF for paying subscribers that is inverse to this. And it looks like it's breaking out. And I've slowly been averaging in on this ETF. I'm to the point where with this decline today, I'm only down 1 or 2%, and I think I'll be up soon on it. And I think that's interesting that MAGs and QQQ both peaked in October, where the market has continued higher recently. So remember, tech is leadership. Tech was easily the biggest percentage of the S&P 500, and it rolling over, I think, could be telling us something here. It's starting to lag. Like for example, let's go look at tech to S&P, basically to the spiders, and that's exactly what you can see. Here's 2021. It did lag a little bit here, but here that's the top, and then it lagged the whole bear market down. Lagged during that 2025 smash. Tech tends to lag, and you see now it's lagged here again, kind of getting that similar 21, 22 vibes, where it started to lag for a number of months, even as the S&P topped, and then the whole market rolled over. So the next thing we're going to look at is Bitcoin, and I think Bitcoin's a really fascinating trade in this because Bitcoin, for whatever reason, seems to be like a risk on trade leader. So we're going to go back 8 years in Bitcoin so we can see the 2018 decline. And um, what we could see in Bitcoin and that first kind of blow off, actually, we'll go back 9 years. And then I'm going to get rid of that so you can see. Because that Bitcoin peaked in the fourth quarter in December, where the market didn't peak till about February 2018. It peaked in December 2017. So it kind of led the market. And then again, 2021, Bitcoin peaked in about October, November, and the market did not peak till late that year, early 2022. Again, led the market lower. And then we look at Bitcoin again. Bitcoin, as we know, is off 40, almost 50%. That's 63,000 is off 50%. And again, it peaked in this October range where the market has held up really to the last month. Maybe because Bitcoin is kind of the ultimate risk on trade. Let's replace one of these price. We're just going to replace this with the S&P right below it, or the spiders. And here's the S&P here, right? And what we can see is again, here. You can't see it because but actually the market didn't really move lower to the fourth quarter. There was a smash here in the spring, and then there's 2020, and then we see 2021, and then yes, you see the S&P move down the whole year, where Bitcoin was already kind of like now down 50% by the first quarter of 2022, and the S&P just was starting to roll over. And then like even well last year it wasn't a huge top, but you see Bitcoin fell with the market. But like I just find it interesting that this last couple of bear markets, which were 2018 and 2022, I don't really include 2020 because the COVID smash was so fast. It was like a V bottom. So, but like I just find it interesting that during those time frames, and even then you can argue, look at after 20 peaking in 2019, Bitcoin was trending lower into that before the market smash. So for whatever reason, and I think it's because Bitcoin is the ultimate risk on trade. And what's interesting now is people seem to be waking up for this. People seem to be waking up to this, that Bitcoin is a risk on trade and maybe not like a currency. And I think that's going to really hurt it in this bear market. Now, another thing are going to hurt it is I've said this, I think that ETFs are really going to hurt it because like this has tens of billions in ownership, these passive kind of ETFs, and these people look at this huge spike here on the panic low, right? And even the spike here on this low. And I've always said that the ETFs are more weak hands. They're not the long-term hodlers or long-term coin bulls, and those people are more likely to get out. Now, I've read recently that the average price these people got in it, because you can see it launched in 2024, is about 80,000. So it's about here, and that's probably one reason this really tanked. So these people are in here, right? And we'll get the actual Bitcoin price. These people are here, and 80,000, you can see right about here, and we're here. So I think now, like, especially there's probably some hope in this last bounce, but if like we get to 45, 50,000, I think those people will start to throw in the towel and begin to sell the Bitcoin ETFs. And then of course, you have other players like of course the MicroStrategy that maybe, because of the amount of debt they took on to buy Bitcoin, may be forced to sell. But I'm not here to talk about Bitcoin. I just want to show you again, we see signs that the market is kind of topping. It's feeling a bit heavy. Like I said, the Nasdaq's been lagging, Bitcoin's been lagging. We're seeing signs again. We're seeing that kind of grinding sideways motion, like we saw in 2021, like we saw in 2024, early 2025. So and then this look. If you look at here, the S&P looks very, very toppy here, right? And if I get the Mag 7 ETF, you can see this looks like it's kind of topping, and the first like resistance would be around 6,800, which are these lows of this year, and then you got about 6,500, and after that, there's really not much. After that, there's really not much because the declines were very shallow. So I would say where that 6,500 goes, we could be in a lot of trouble. And again, like I said, if you look at the mags, they're right here too. You can see about 62 where they're at right now. They're 62.19. They're very close to kind of breaking down. And then I would say like 57, 58 are their next thing. So we'll just watch this. But look, at corrections happen. We're in this weird part of the economy where I think the economy is slowing. And but the Fed, because it's like that jobs number basically ensures the Fed's not going to cut till June unless there's some kind of big downturn in the stock market. But like, and the reason that the stock market is not a leading indicator anymore is that so much of the economy is bent on the wealth effect, bent on the Magnificent Seven going up, needs the stocks going up because so many people are doing that. Are investing. The market and the economy are more concurrent together now. Now the market goes down 20, 30%. The economy weakens a lot because there's no wealth effect. And the economy is built so much more on the wealth effect. It's not like in the 70s, 60s, 70s, in the 80s, in the 80s, the stock market boom started. People were making good wages and good money. And the economy was more bent on people being hired, getting good jobs, getting paid well. Well, now, interest rates, because, people like couldn't afford a house in the early 80s when rates were in the double digits. It's not so much that anymore. Now it's more, well, if Microsoft, Apple, Amazon, Nvidia, Tesla, etc., don't keep going higher, then people are going to have problems spending money, right? So let's see what happens. Because I know, like I was just reading recently, this is the last thing I'll say, that the Bahamas now has, and this is off top of the stock market, 85% of the tourists that come to the Bahamas are now American. That's the highest of any of the Caribbean countries. And one thing I noticed about the Bahamas when I went to Nassau in September, October, I was like, Nassau, obviously there's still rough parts and that sort of thing, but I mean the actual resorts, I was like, wow, this place is super high end now. There used to be these mid-end resorts, even lower mid-end. Nassau never really had super low-end resorts, like, but like it was like I was like, wow, like everything here is so expensive. All the new resorts are super nice, super new. Even the Margaritaville, which is downtown, which you would expect to be a mid-end resort, is pretty high end. And I was just like, and that's what's attracting the Americans because Americans have money. So, like, that means that's it. Same thing I'm trying to say. The Americans that are coming to the Bahamas, spending all this money, are probably the types that are making money in the stock market, et cetera, because the Bahamas is a higher end now destination than, say, Jamaica or Dominican. There's not all the all inclusives. It's the cost of living here is more expensive. The standard of living is higher. So I just wanted to put that, and that's the kind of thing we're seeing as an offshoot of all of this stock market gains. And I'm going to leave it at that. I think next week we're going to talk a little bit about interest rates, but I just wanted to show you, I think we are seeing signs of the market topping, etc.